Hey folks, it's Rob Flux here with another Sunday session. Apologies for going a tiny bit late. Was running another event for, teaching a couple of people out there. So today is open mic night, so it's your opportunity to ask me questions. Now, in preparation for today, we actually put a link out to people, and I've got about 10 questions already in the queue. So what I'm going to do is I'm going to go to those questions now. But if you have any burning questions, I guess I'm going to have a limited timeline. So this is not going to be, a free-for-all, but I guess we'll keep it within the hour. But if we can get as many questions as we can within the hour, that will be what I will try to do. So in the meantime, I guess if you want to ask some questions in the Facebook stream, make sure that you actually put the questions in there. So let me just try to grab my questions. So apologies for coming in just a tiny bit ill-prepared, but because I was running a little late. Okay, so first question came from Michelle. So Michelle asked a question, hi Rob, would you normally consider purchasing a site with a DA approval? So that's the question mark. I often find sellers jump to the price quite a bit with especially a complicated development approval on it. What would be a reasonable price increase for us to consider for it to be a worthwhile deal? So, Michelle, I'm going to start by saying, look, there's a couple of different instances where a development approval doesn't actually add a lot of value to the site. So you want to be very, very careful that not every development approval gives an automatic uplift. So it's got to be the right kind of product for the area. That's the first thing. And there's also got to be enough demand in the area to actually make that worthwhile. So if you have the wrong product, it's not going to make sense. So what you need to do is you need to kind of firstly work out, is it the right kind of product? Then what would that product actually sell for? That then works out what is the GRV, the gross realized value of the property. Okay, so that is the finished product. What's that going to sell for? Then you want to start to work backwards. So instead of kind of working from the bottom up and say, how much is the vendor asking, adding all your costs, and then can you live with the profit? You want to go the other way. What you want to do is to say, look, if I know what the finished product is going to sell for, the first thing I do is I'm going to subtract the profit that I want to make. Now, if anyone's read Robert Kiyosaki's book, Rich Dad, Poor Dad, rule number one is pay yourself first. So if you understand what that needs to be, you need to make sure that you've got enough profit in the deal that the bank is going to lend you the funds that you need in order to make the project actually work. Then you subtract all the costs, and then whatever is left over is the maximum that you can pay in order to lock in that profit. Now, that's a key differentiator to the way most people actually look at deals. So did it give you an uplift? Well, that really comes down to, could you lock that profit in? Because you don't want to squeeze your profits. Instead, you want to lock your profits in. So that top-down approach from a feasibility, very different to a bottom-up. The bottom-up is the vendor dictates the price, then you add up all the costs, then you see what the GRV is, and you see, can you live with and squeeze that profit margin as tight as you can, and can I live with that? And what you do is you get over-optimistic on the sale price, and you get over-optimistic on your ability to run the project perfectly to squeeze that profit in. And so that's, a dangerous way of looking at it. So did you get the uplift? Really comes down to that top-down feasibility approach. So hope that gets you there. And what you'll find when you do that is that in many instances, there is no profit in the deal. Or you sometimes I've found sites where they would have to give you the site in order for you to actually get any profit out of it. And clearly, they're not going to give you sites. So does every development approval give you an uplift? The answer is no. But if you do that approach, it should help massively. So that's question number one. If anyone else has got questions, as I said, pop them into the chat window and I will do my best to actually answer them within the hour. Next question is from Baljinder. So Baljinder says, I have an investment property of 1.3 million with a 650K loan and a rent of 700K, and I won't name the suburb, okay? Would it be good to sell the property and use the funds towards doing development in the future? Thank you, Rob. You're a legend. So firstly, Baljinder, thank you very much, mate. The first thing I'm going to say is I can't give you, financial advice on the individual project because I don't know that, intimately. I don't know the area. I don't know the project. I don't know the demographic. There's a number of things that go there. So I want to talk to you about the principles, and that's going to help everybody, not just you. Okay. So the first things first is you bought the investment property for a reason. Now, there's only four reasons to buy a property. Okay. So there's capital growth, there's cash flow, manufactured profit, which is property development, and lifestyle. So I'm going to assume the fact that you said that it's investment, that it's either capital growth or cash flow. So the first thing you want to do is have a look, that was the purpose that I bought the property. Now, what you want to do is measure every 3 months or so, is it meeting its original intended purpose? So if your intended purpose was long-term capital growth, then you want to start to do some measures to say, have I achieved that long-term capital growth? And if I have, what's the likelihood that that's going to continue? So if the answer is no, it didn't meet its objective, then the answer is really simple for you. I bought it for a purpose. It's not meeting the purpose. It's dead weight. I should probably do something with it. If the answer is yes, it's meeting its purpose, so I bought it for capital growth and it's achieving capital growth, then the next question is, well, given that's the case, do I want to leave the property in place because it's performing exactly as intended, or B, because I'm learning a new career in property development, is there an opportunity there for me to pull the cash out and recycle it into my own project and be more efficient and more effective in that? Now, that's going to change for different people at different phases of their journey. So if you're just at the start of your journey, only a couple of months into, learning the process, then it's probably a little premature to pull the money out. And the longer you leave it in, the more it's actually going to grow for you. So you've got time on your hands to say, well, I can actually wait. I can learn the skills. It's going to keep getting capital growth because that's what it was there for. And then when I'm ready, I can actually sell that down. When I'm ready to actually use that money better to actually do that. If, however, you're, at the tail, not the tail end, but you're at the tail end of your learning process and you're deal imminent, and you're a little bit concerned about not having the cash flow that you need and things like that, then there's an opportunity that you might say, okay, it might be the time to cash in now because I think that I can actually repurpose that cash a little bit better with my new intended strategy as opposed to what I had before. So that's the process. Now, how do you measure whether or not you're actually achieving that capital growth? Well, you want to start to look at your supply and demand measures and metrics that sit in around that. There's a fantastic website that I use on a regular basis. There is a cost to it. So it is a subscription-based model. It's called DSR data. So it's short for demand and supply ratio, DSR data. And that can have a look at not just the capital growth, but it can also look at the rental yield. It can look at vacancy rates. It can look at days on market and a whole bunch of other metrics that sit in around your property to determine how your property is actually currently performing. Now, it's at a suburb-wide level, so it's not going to look at your specific property, but it should tell you, on average, how is that suburb actually performing, and if that suburb's performing well, excuse me, if that suburb's performing well, it'll give you a measure right here, right now, but it'll also give you a measure against time. So it'll go, look, every couple of months or every month or so, they do the updating of the stats. And so you can actually see over time, has it been performing well for a very, very long period of time? Because you might go, yeah, it's performing great right now, but it was performing better and now it's on a downward spiral. That might be a very, very different answer to, hey, it's performing well now, but it's actually on an upwards trajectory and I want to let that thing ride. So you want to be looking at all of those metrics and look at them on a regular basis to not just make an ad hoc decision, but rather make an informed decision that evolves over time as the information gets updated over time and as your skills update over time to actually enable you to be a little bit more prepared for when you actually pull that out, okay? So hopefully that works, mate. I guess that high level approach. And as I said, you can kind of pull those stats out of DSR data. When you do, what they do is they tell you how that suburb is actually reporting, and they compare that against the Australian average. So you can actually see, am I performing better than the Australian average or worse than the Australian average? Clearly, if you're performing worse, you could be investing that money somewhere else better. So I guess holding on to a lemon is probably not a good idea. But if it's performing well, then you've got choices about, well, I want a time when. Okay. Hopefully that helps, Belginder. Next question I've got is from Claire. So Claire says, I've found that it's hard to find the site which has the numbers stacking up. Most of the sites are overpriced. People pay more than what they are worth, especially ones when real estate agents advertise that it's subdividable. What are your secrets and or tricks to secure sites? So Claire, there's actually a couple of questions in there. So if you're okay, I'm going to dissect that out a couple of different ways. So firstly, I'm going to make a statement to say 90% of all developable sites are not profitable. So it's not uncommon to find sites that don't stack. Okay, so that's the first part. Just make that blanket statement. The second thing is, depending upon what you're trying to do, have you actually done a market analysis to say, look, on average, is this area actually going to be profitable for me at all? Now that's a key question to ask, because there are suburbs where almost everything that you touch turns to gold, and there are other suburbs where everything you touch turns to something other than gold. Okay, and very different color. So you want to be, I guess, doing your suburb research to make sure that, firstly, is there lots of opportunity for what it is that I'm trying to do? And then, secondly, is there evidence of other people doing those deals, and reverse engineer those deals and say, are those people actually making money? And if they are, then the next question to you is there enough demand for what I'm trying to do in the area that it's more likely that I'm going to make money too? So that you don't want to be the first person into an area, but you also don't want to be the last person out. So what we're trying to do is to just have a look at evidence of other people first, proving that those deals actually work. Now, when you break that down into its simple steps, it's actually not complicated from a process perspective, but it is effort from a doing perspective. So what you want to do is to say, look, given my development strategy and given my development size, I need to have a very specific land size and a very specific zoning within that council. So you want to make sure you do all the research to make sure you know exactly what those things are. Then you want to do the research on the suburb to say, well, what does a developable site typically sell for? So is it a raw site? So land size and zoning, what does that sell for? Then you're going to start to go, well, I can see all of the opportunities that have sold in the area that match the land size and match the zoning. You want to start to eliminate the ones that are not representative of a typical development property. Now, a typical development property is one where you're happy to knock the house down. So you wouldn't be knocking down a brand new home because it's got too much intrinsic value. You probably wouldn't be knocking down a house that's been substantially renovated. You wouldn't be knocking down a mansion. So when you look at the land size and you look at the zoning, you're going to start to then put a little layer of information, a little layer of extra assessment to say, does this represent something that would be something a typical developer would actually buy? So what we're trying to work out is, what is the typical purchase price of a typical developable site? Okay, and when you know that answer, then what you do is you go and do the same research, but this time for the finished product. And then what you do is you subtract one from the other. You know what the cost of your project should be to run. And so then you can actually work out, well, on average in that suburb, if I buy a developable site on average, if I run an average project and I sell the average typical property, would on average I make money? And if there's lots of those opportunities and high probability of success, that's the area you want to start to anchor down in. It's amazing how many people don't do that level of effort. They go into an area where there's hardly any opportunities, hardly anything with the zoning, hardly anything with the land size. When they do, even if there are lots of those opportunities, in many instances, on average, it's not profitable. So you're banging your head against the wall, hoping underbid the market and hoping that you can pick up a bargain, and it doesn't always work. So you want to do that reverse analysis of the entire suburb first. That will tell you whether or not you're actually in the right area. So hoping that you get plenty out of that one, Claire. Now, Marv has a question. Marv says, "Hi, Rob. Just wanted to ask, what would be your number one surefire method for attracting money partners and investors?" Marv, a couple of layers. There's probably not a number one surefire. This is a little bit of a black art. But probably the first thing that I would say is don't wait until you have the deal to try and convince an investor to come on board. What you're trying to do at that point is you're trying to convince a complete stranger to firstly know, like, and trust you. They're three words that I want you to really embed in really hard. They need to know you, they need to like you, they need to trust you. If they don't know, like, and trust you, then they're not going to look at the deal favorably. So if you've only got 14 days to get your finance approved to get an investor in, you've got to convince them to know, like, and trust you. Then you need to convince them that they like the deal. Then you need to convince them to get all the legals done. Then you need to convince them that they need to get their finance approval. Then you need to get them to say, well, in order to get my finance approval, I need to have my tax returns done. So you're trying to compress a whole bunch of stuff into a very, very limited timeline. Instead, what you want to do is you just want to decompress that into a much bigger timeline. And I want you to do the know, like, and trust element, that know, like, and trust. You want to do that for months, well before a deal actually comes. You want to get them deal ready. And you say, look, I want you to build that level of trust. Ask me any question you like. Those sorts of things very early in the piece. Hey, when we get to the point of getting a deal, we're going to be in a hurry. We need to act fast. Otherwise, somebody is going to grab this from underneath us. So in order to do that, we need to get you deal ready. To get your deal ready, you're going to have to go get your finance approvals. So in order to get your finance approvals, I need you to do your tax returns. I need you to be up to date. I need you to go talk to your finance broker, actually get that pre-approval ready to go. We're also going to need to get our legals done. So why don't we do that now while there's no time pressure? You can ask me any question you like. We can go back and forth, get the terms all locked in. And then when we get to the deal, then at that point, all the hard stuff's ready. We're deal ready. Now what we want to do, now we want to get to a point where all we're doing is actually looking at the deal itself. And it takes away all the emotional element. And instead, we just look at the specifics of the deal. So everything that you do leading up to that is all about building rapport, building trust, showing them that you've got the skills, showing them that you're farming in the right areas, showing them that you're a trustworthy individual that is going to give you the outcomes they're actually looking for. So get to know that person really, really well. Now, the thing that, if you want a number one surefire, what's the thing that we don't do? There's a secret tool. It's so secret that it's hiding in plain sight. There's a secret tool where everybody already know, likes, and trust us, and that's this thing here. This thing here is your phone. Everyone in your contacts list, they already know, like, and trust you. So do not be afraid to talk to the people in this phone. What they don't know is that you're a property developer, okay? So what you want to do is just slowly, over time, start to let people know what it is that you're doing. See if they actually will show a level of interest in what you're doing. Don't go saying, hey, have you got money? But instead, just talk about your property journey. Talk about, hey, I went to this property meetup on the weekend, or hey, I went to this boot camp on the weekend, or hey, I'm doing my suburb analysis. I spoke to 3 agents on the weekend and they all gave me some cracking leads that I'm actually going and investigating. So when you start talking about what it is that you're actually doing, then people will start to show an interest, or they'll do the opposite. Now, if they do the opposite, they're not interested in your property development journey, that's okay. Just let that go. But if they show an interest, they're the people that are likely to become your future investors. So make sure that you're letting everybody in this tool here, make sure that they are all knowing that you are a property developer and that you are prepared to do what it takes to actually get the deal done. Okay, now that means talking at your barbecue. That means talking at your skids footy practice. That means that means talking over the water cooler at work or over in the lunchroom at work, those sorts of things. It means talking about your property journey the whole way. And it's amazing how many times I see that we are afraid to let other people know what we're doing because we're worried that they'll prejudge us. So I want you to break down that stereotype. I want you to get away from that in total. Otherwise, what you're going to find is there's just there's no opportunity if you don't open the opportunity up for yourself. Hoping that helps, Marv. Next one, Chasen, you've got a number of questions here, so I might kind of answer one, then kind of answer some other people, then see if time permits and come back. So, Chasen, you've actually got 3 different questions here, so I'm going to try to, space that out. So, Chasen would like to know the different types of different types of roofs, concrete poured versus normal timber framed roof, the cost comparison. I'm just expanding that out a little bit. So then you've got for flat top roof for both types, concrete poured and timber framed, how is rainwater / rundown managed and cost comparison? Chasen, I'm going to say I'm probably not qualified to answer that question. That's probably more a builder that you want to actually talk to with regards to how a different engineering solution might work for your different product type. I guess what I can say is when you go to a builder, what actually sits underneath, is it concrete? Is it timber? Is it all those things? They're not really relevant to you. What you want to know is, does it have the look and feel and the cost that I'm actually looking for? So I would be going to the builder and saying, look, the specification of the look that I'm trying to achieve is this. This is the specification of the design. How that's actually engineered underneath, whether that's concrete, timber, or otherwise, whether it's steel, that's probably less than relevant. And let the builder determine, because the builder is going to have a relationship with their own different suppliers. And you'll find one builder that's got a fantastic relationship with their truss manufacturer, and they'll be able to get some cracking prices. And another builder is going to have a fantastic relationship with their steel frame people. And you might get a very similar outcome from very different people. But if you ask for the opposite answer from both of them, then both of them are going to blow out the price for the same thing. So it's all about horses for courses, finding the right builder for the right job. Now that said, I know that you also asked the exact same question of our industry expert at yesterday's Melbourne-based meetup. So I'm going to kind of leave that one there for you. And I know that you're going to follow up Henry Villa on that in detail. So that's probably the best place to actually go for that one. Next question, and reminder, folks, I'm going to try and answer these questions within the hour. As I said, I'm not going to go endlessly. So if you have a question, type it into the chat window. I do have a whole bunch of questions that were pre-submitted. So I'm just going to get to the hour and I'm going to stop. So this is not going to be an unlimited free-for-all, but we're going to run these open mic nights relatively regularly. So if I don't get to your question today, I definitely will get to it over time. So Paul has a question. Paul says, hi, Rob. I've found many potential sites. How do you determine all development costs for your FISO quickly and accurately when the market is moving so fast? Consultants will take some time. So, Paul, that comes down to, I guess, a methodology that I use, which is somewhat different to what other people out there teach. Okay, so my methodology is all about narrowing down your expertise so that you are super granular in exactly the development strategy that you want to do and exactly the area that you want to do it. So, what council you're trying to do it in. And also then narrowing that down to 3 councils. So, I want one strategy, 1 council, 3 suburbs. Now, if you narrow, if you narrow down to that, you're going to start to know within an inch of your life every single cost for every single one of those elements, because the cost to do that exact same development in the next council might be completely different. They have different application fees. They have different fees for the headworks charges because it's using a different utility provider. They might have different, council contribution fees. So you'll find that the exact same strategy from council to council may cost you different amounts of things. So you want to get really, really granular in what it is you're trying to do and where it is you're trying to do it. And you're going to start to become an expert in the development strategy, the rules for the council, and who the consultants are that you actually work in the area with. And by working with those consultants, you're going to build a rapport with them where you're going to get the answers that you're seeking. What I sense from your question, and what I see a lot in our community, so apologies if this isn't new, but what I see a lot in our community is people looking at too many strategies in too many places. So they're not sure of the costs because the cost in one area and the cost in the other area are different. And so then, it starts to confuse them. If you narrow that down and get super thin in what you're doing and super deep in the knowledge, you're going to start to be able to quote those things straight away. So you want to start to become that strategy expert and that area expert, and most of those answers will actually come to you. Now, with regards to the markets moving so fast, you're right. The market is moving fast, although I guess the sales of the market is starting to slow down significantly at the moment. So that's starting to come back into a little relative normality. The cost of construction materials is still changing quite variably, although that's again starting to stabilize. So we're starting to see a little bit more predictability in what's coming up. Right now, there's still a little bit of uncertainty from a construction cost perspective, but that's by having great relationships with your builder. If you've got that great relationship with the builder, he'll be able to give you, or she or they will be able to give you fantastic insights into what that looks like, and how much that, that they'll be able to say, look, I can see the cost of concrete is being predicted to go up 5% next month. So factor that into your costs. The cost of timber is likely to go up again. So start to factor that in. Now, the cost of one material doesn't necessarily reflect, I guess, an entire, the cost of everything in your project going up. So, timber is only used in certain places. Concrete is only used in certain places. So the one element going up won't have a huge impact across everything. It's really the accumulation of all of those. The other thing that will help massively is having a really good relationship with the quantity surveyor. They see those market trends with regards to the cost of construction and the like, and they're going to give you some really good insights into where those construction costs are actually going. So hopefully that helps you, Paul. Now, next one is from Ursula. Ursula says, "Hi, Rob. I own 2 properties in Geelong, and I have been discussing a JV with a couple of developers. How do I make sure that the deal is fair and the numbers stack up? What's your view on cash flow properties?" Oh, and then there's a second question. So what's your view on cash flow properties? So I'm going to just ask the first one. So the first one is the JV partner. So again, Ursula, rather than me talking about your particular projects in Geelong, I'm going to broaden this out so that everybody gets some benefit from it. Whenever you're going into, any sort of joint venture relationship, the first things first is you want to make sure and do a self-assessment against yourself to say, where are my strengths and my weaknesses? What are the things that I'm not good at? And is the other person in this deal, is their strength the area that I'm weak? So that's the first part. So if you're not, excuse me, if you're not good at sorry, excuse me, 2 secs. If you're not good at feasibilities, then is the person coming in good at feasibilities? If you're not good at project management, is the person coming in good at project management? If you look at your strengths and weaknesses and their strengths and weaknesses, you want to make sure that there's a really good fit. What you might find is you're strong in one area, they're equally strong in the same area, and so the two of you are going to have a difference of opinion. You're going to start to clash. What you want is to have complementary things where you actually supplement each other's capabilities really, really well. So that's the first part. The second part is from a personality perspective. Are they someone? Are they someone you actually want to work with? Is it someone that has the same morals, the same work ethic, all of those? Are they genuinely just nice people? You want to start to understand that. You might do a personality profile with them and equally do one with you and swap them over and then start to discuss, look, this is what that personality profile means. This is how I react under pressure. This is how we're going, how I deal with problems and the like. Some people you'll find get really stressed and paranoid under pressure. Other people thrive and they just kind of push through. You want to do those personality tests and see how that plays out. That gives you some really good insights into their ability to deal with things under pressure. Because let's face it, you when you're running a deal, you're going to be under pressure. So it's really important that you work that out up front. Then the next part is, I guess, looking at the finances. Do between you and them, have you got the financial resources to run the deal from start to finish? Um, so that's important because you don't want to kind of go in with the thought that you're going to get there and then find out later on that you can't. Um, that would then involve, okay, well, we've both said that we're financially secure. Let's actually now start to either do full open disclosure. It might be a letter from the accountant. It might be showing each other's bank balances. It might be a few things like that where you go, look, I'm good for this, and here's proof, right? Typically, that's going to be either a letter from their solicitor, or a letter from their accountant for them to say, yes, we've actually assessed their condition and they're good to go. That's super important because you don't want to get to a situation where your other partner starts to run out of resources. You also want to know other projects that they're working on at the moment, because if they're stretched too thin, or what their workload is from a day-to-day job, are they stretched too thin? They might not be able to deal with the additional work that's actually going into the deal. Lastly, do they actually understand the deal itself? Is this a major step up in deal size for them? Maybe they've never done a deal this big. That's important to know. Then it doesn't mean automatically that you're not going to trust them, because everyone has to do deal number one, and everyone has to step up to a bigger deal size at some point. It's more, hey, what kind of context are they coming in here? Have they done the homework? Have they got a mentor sitting over them? Have they done a couple of smaller versions of the same project that they're actually just building on previous skills? So that's important as well. And probably the last element would be, have you both got the same exit strategy in mind? There's no point you wanting to take it all the way through to completion and then wanting to sell it as a development approved site. And you get to that stage and you're having fights with regards to how to get out. Excuse me. So if you do all of that, then you want to make sure that you map all of that out on a joint venture document. Now, in my property development formula program, we help our students out by giving them a 40-page joint venture document template that they can take their solicitors as a starting point, and it deals with all sorts of issues like what do you do when there's conflict? So conflict resolution. What do you deal when one person wants to keep some stock at the end and the other person doesn't? What do you do when somebody gets sick halfway through the project and can't complete it and they can't fulfill their obligations? You want to go through all those different what ifs and make sure that you've actually solved those problems up front. Because if you don't solve them, otherwise what will happen is you'll actually get into the project and you're going to find out halfway through, and it gets tricky at that point to navigate your way out of that. So hoping that you get plenty out of that. Now, Ursula, you do have a second question. So if time permits, I will come back to that. But for now, I'm going to move on to someone else's question and I'll come back to that if you're okay. So Rashan's got a question. What advice would you give when speaking with prospective landowners, JV partners, to allay concerns that they may have in entering a joint venture? In particular, how can we best provide assurance that the attractive financial returns of the deal significantly outweigh the complexities and risk of doing the JV, and that we genuinely have their interest at hearts and are committed to delivering the best possible outcome for them? Rashan, really good questions, and they all come down to building rapport. And in building rapport, it's not about you, okay? It's about them. So the first thing that you want to understand genuinely, what are their needs, okay? Now, their needs are the things that they must fulfill before they ever consider going into the project in the first place. So the needs of people are going to change from person to person. That's going to change based on their financial situation. It's going to change based on their personality. It's going to change based on their risk profile and a whole bunch more. So you want to get really deep and have really deep conversations with them to actually understand what are their motives and drivers in the first place. And then you want to be able to then position the project in such a way that it meets their need. Okay, so as an example, and this is purely just an example, when you talk to them about why you're looking to sell in the first place, generally you're going to get a superficial answer. So I'm just looking to downsize, or the backyard's a little bit too hard to maintain. That's a fairly superficial answer. What you really want to do is drill a little bit deeper into the answer and start to ask a question about the answer. So the question might be along the lines of, understand that's a little hard to maintain, but what would the finished product, what would the perfect finished product look like for you? So what you're trying to work out is, are they wanting an apartment? Are they wanting a duplex, a townhouse? Are they wanting a house on a small lot? What is the finished product actually start to look like? If you know what that finished product is, and you think that your project might be able to deliver exactly that outcome for them, then what you do is you demonstrate that you listened to them by repeating back what you heard. So let me understand this, and let's just use the word John. Let me understand this, John. From what I understand, you're wanting to downsize because the backyard is a little bit too hard to maintain. And my understanding is that you'd be happy with something that still had a yard, but it was much smaller. So something that was either on a small lot of land is probably what you're looking for. If I was able to solve that problem for you, would you be in a position to move forward? Now, note the second part to that. The first one is you acknowledged their need. The second part was you actually proposed a question to them in such a way that you are expecting the answer to come back to be yes. So, if I was able to solve that problem for you, would you be in a position to move forward? Now, of course, if you solve the problem, they're going to want to move forward. So the only way for them to answer that is yes, if they're genuine about selling. Now, they could answer no if they're not genuine about selling, but that's really what you're trying to get to. Now, as you start to drill into that, and you're going to go a little bit deeper into what that kind of product looks like, it would be, for example, are you looking to live in this area, or are you looking to move out of area? Okay. And if they're looking to move out of area, you might say, have you already found that new place? So if they've already found the new place, then chances are their need is, well, I need the money to pay for the next place. That seems to make sense. But if their answer is, no, I haven't found the next place yet, then their need probably is that they need time to find the next place. So you want to be listening very deeply to how that conversation is and try to distill not just the words that they're saying, but the underlying meaning and underlying intent of the core need that sits underneath that. So what I heard from you, John, is that you haven't yet found the place. You're looking to move on somewhere else, but you haven't yet found that place. And so what I understand is you're going to need some time in order to do that. If I was able to give you the flexibility of that time so that I didn't kick you out today, would you be in a position to move forward? And again, we've repeated the need that we listened and we understood, and then we've repeated a question that you're expecting a yes as an outcome. Now, if you keep doing that in such a way that you get a yes, then a yes, then a yes, then at the end of that, you're going to say, look, based on everything that I've heard, and what I heard is you want to downsize to something that's, on a smaller lot. You're looking to move out of area. You haven't yet found the I guess the particular property that you're looking for. So if I understand all of that, then what I'm going to propose to you is a little bit different to a normal everyday sales contract. And so I'm not sure if it's something that would be of interest to you. Would you like to hear my proposed solution? So you're asking them for permission to then actually propose the solution. Now, you've gone yes, 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 yes. At this point, it's very hard for them to say, no, I don't even want to hear what you've got to say. And now, if you then present your solution so that it meets all of those needs, and that's the key initiative here, it meets those needs to say, look, I'm going to be able to give you a little bit of an uplift in price because you've given me the flexibility of time. I'm going to give you the flexibility of time yourself to go find the next place. And when you start to marry all those out, then your proposed solution is the only solution that can actually achieve all of those needs. At that point, it now sounds like it's their idea. And that's the key, right? Is to actually position it in such a way that it sounds like their idea, because you only proposed it because you listened to them. Now, so you built rapport the whole way, and now it looks like your answer. Where I see most people do it is the opposite way around. I want a JV, so I'm just going to go in, hey, mate, do you want to do a JV? And I'm going to start to ram it down their throat. And because of that, it's like having a toolbox with only one tool in the toolbox, and that tool is a hammer. So then everything starts looking like a nail. So if you start doing that, then the other person's going to be a little bit off put. They're not going to want to answer those questions. And so what we want to do instead is we want to position it so that it then looks like their answer. So, Roshan, hopefully you got plenty out of that, mate. Andrew's then got a question. So Andrew says, "What specific checks do you do when engaging a builder?" Now, clearly, Andrew is in Queensland, so because he's asked about the QBCC, which is the local Queensland Building and Construction Commission. But there's a whole bunch of different relevant authorities in the different states. So let's ask this in a I guess a little bit more generic way so that everybody gets something out of it. So the first thing you're going to do is you're going to ask for reference checks. That's really important for I guess them to demonstrate that they've got clients that they're happy to present. Now, of course, they're only going to give you clients. They're going to speak to them, I guess, in good light. But you still want to speak to them, because if they're the ones that they're putting forward as their best client, and those best clients don't give a glowing referral, that's probably a really good insight in and of itself. The next thing you'll do is you'll actually go to the relevant building authority. So that changes from state to state. In your instance, QBCC, and you're going to look up all of their history. So search for their license, and you'll be able to say a history of all their projects. So I want you to then look at those projects and then start to reverse engineer those projects and go look at the previous development approvals, see if you can find who the developer was. In many instances, it's actually written on the development approval documents themselves. So you're going to do the council searches to pull those out, and then just do a mystery shopper. Call the other clients that weren't their preferred clients and see, I guess, what they come back with. So that's a good thing. Those people are then references that were unsolicited, so you've gone and approached those. Next one would be, whilst you're looking on that license portal, you're going to see, are there any blemishes against the builder's name? So was there any claim against the builder? Now, I want to be careful here, because sometimes good builders make mistakes and people make a claim against them. So it's not about, hey, there's a blemish on their record. What it's about is, how did they solve that blemish? Is there an ongoing litigation? Did that in the right way? So you can look up what those blemishes are. You can see how they were actually resolved. You can actually ask the builder about that. You can ask to speak to that particular person who was disgruntled and make sure that was satisfactorily resolved. So that's really important to do as well. The next one would be, go through some of their existing projects, see the quality of finish, and particularly something that is of a similar quality to what you're anticipating to build, to make sure that what you're anticipating is reflective of the quality that they're doing. And last one, which is probably one that most people wouldn't think to do, ask for the builder to say, who are the building certifiers or the building surveyors, depending upon the state that you're in, that you use typically. And can you please give me their contact details, because I'd like to talk to them, because they're the ones that are checking on your work, okay? If you go talk to those building certifiers or building surveyors, then they're going to give you a really good insight to say, look, yes, every time I go out there, it's only 80% complete, or no, it's always 100% complete. Every now and then it's not quite done, but they always remediate straight away as soon as I highlight an issue. So that's the person who's signing off on the work. If you see issues and challenges with that work being signed off, that's probably in itself a really good indication that the work is not to a sufficient standard. Um, Lastly, you want like how do they deal with things under pressure? So, have you got examples of projects that didn't go well? So, hey, I'd like to see a project that didn't go well. I want to see what the problem was, how you resolved it, what the issue was, and did that get satisfactorily resolved? Because it's not about how do they do things perfectly every single time, but it's about how do they deal with things when it doesn't go to plan. How do they deal with things when things aren't quite right, and that are they going to stress? Are they going to get angry? Are they going to get abusive? Are they just going to dig in deep, and get the job done? Uh, so all of those, I guess, indirectly are different ways of getting reference checks uh, on on the people that have worked with them in some way, shape, or form in the past. So hopefully that helps, Andrew. Just take a small sip. Now, mindful folks, that we've only got about 10 minutes to go. I did say that I'd try to limit to the hour. I will check the Facebook list to see if there's any questions through. So I've got one more question that's been pre-submitted, and then I'll go to the Facebook community and see what questions are there. So Raymond asks, my burning question is, I have much equity and want just trying to read the language. Sorry, have a reasonable amount of equity, and I want to meet like-minded people and know how to raise finance to work with like-minded people in I guess Melbourne/Victoria to get involved in property development. Start small and build. Okay, so it's really how to connect with like-minded people that are looking to do the kind of things that you're doing. It's not clear here, Raymond, if you're the money partner and you're wanting to come up with developers, but that's kind of how I've interpreted that question. What I would say, mate, is there's a couple of different ways that I would do this. So, firstly, we have two Facebook communities. We have our Facebook group, so Property Developer Network, and we also have one called Development Site Deal Hub. Both of those are great places to tell people, hey, I've got some funds and I'm looking to invest in a deal. Now, be very, very careful. The moment you do that, it's going to be like seagulls on a chip. Everybody's going to kind of come flocking and say, hey, I want his money. Everyone's going to make out like they're experienced developers. And so you're going to have a lot of noise that you're going to generate in that process. So you want to be very careful in how you articulate it, what you articulate. You might instead just watch the community and see the kinds of people that you want to work with. So the kinds of people that are contributing to the community, very knowledgeable in their responses, that are putting up regular projects in the Deal Hub, things like that. And you might selectively reach out to one or two. The next thing is make sure you come to the local the local meetups that we run every single month. Now, you're based in Melbourne, so in Melbourne, it's the first Saturday of every single month. As a matter of fact, we had one yesterday. So if you're coming to those every month, you're going to start to build a rapport with people. You're going to start to understand from a personality perspective whether they're a good match. You're going to start to understand what their skill sets are, etc. You also want to start to do research on them to make sure that they have done the kind of projects that you're looking to do, that they've got the runs on the board, or if they don't have the runs on the board, that they have at least invested in their own education to actually get the runs on the board, which is super important because not everyone will be able to do everything every single time. Okay, so don't stress over that. Everyone has to do deal number one, but you know will you be that person to invest in them? Maybe you want to invest in their first deal. Maybe you want to, if they've done all the pre-work, if they've gone and got themselves a mentor, if they've gone and done the homework, if they've gone and found areas where there's high probability of success, all those sorts of things. If they've done the homework, absolutely go back them. Okay. If they've not done the homework, then clearly you don't want to engage with them. So you want to do that homework and research on them. Haven't asked for them for a reference check, haven't asked for them to show their previous projects, all those sorts of things. Okay. Anyway, hope that helps. So, guys, there's about 5 minutes to go. What I'm going to try and do now is I'm just going to try and jump over to our Facebook group, see if I can actually find some questions that have been asked directly into the community and see what happens there. So, give me 2 secs. To our Facebook group, see if I can actually that have been asked directly. Hang on. We always get a little bit of a feedback loop. So Okay, so I can see a couple of questions here. So Damien's got one. Damien says, can you suggest an estimated cap rate that a bank would value a childcare development with a triple N lease for their own valuation? Equivalent properties are selling at 4.5% cap. Should I be expecting a difference? So, Damien, I will firstly say I'm not experienced in childcare, so this is probably not something I can give you, I guess, an authoritative answer on. What I would say, though, is to say that it really comes down to, are you looking at this as a raw site, or are you looking at this as a finished product? So typically, what you'll find is the valuation is going to be based on how many heads, or how many childcare seats there actually are in the area, what the demand is. Is there too much demand? Is there too much supply? That's going to change the potential revenue that each child can actually generate. So are they generating, you know, and I'm kind of making up numbers here because it's not my expertise, but are they at the bottom end of the range, or are they at the top end of the range with regards to how much they're generating from a revenue on a per head basis? Then your cap rate then is dividing, I guess, that total revenue by that to then come up with the valuation. Now, clearly, if that's a DA approved site, or if that's a fully constructed site, they're realizing everything right up front. Whereas what I'm going to encourage you to do is actually try and find the site in its raw form, where there's been no commercial value added already, and that the skills that you're going to bring to the project is going to allow you to add that development approval, and then you're going to get the uplift. You get the arbitrage between the raw site and the DA approved finished site, and that uplift, applying those same cap rates, will get a much, much better return. So that's probably as far as I can go. If you start to look at, there's a couple of commercial research tools, and their name is just escaping me momentarily. But they go and look at all the leases for all of the different projects around the place, whether they be medical, whether they be retail, whether they be office precincts, etc. And they capture all of the rental returns on all of those. And one of them has just changed names, and I just can't remember the name of the new name. But you can actually do those searches anyway and go, well, what is the cap rate in the area for raw versus cooked? Hoping that helps. Fabiana's got a question. Hi, Rob. Given that 2022 appears to be similar to the past 2 years, re material prices, volatility, shortages, how is the negotiation with builders in the case to ask for dollars above the agreed building contract? Can they ask whatever they want? This is a long question. You've got questions within questions here, Fabiana. So I'll read out the whole lot and see if I can just kind of summarize in one bit. So builders know that almost always the option for developers to continue with the builder. How is the new number agreed? I understand that the prices go up, but this can eat the profit away from the developments, etc. So, okay, let's kind of break that down, and the question goes on a little bit further. Let's try to break that down. So, firstly, you've got a couple of competing challenges here. So, the competing challenge is that you want to have a fixed price because you want to know exactly what the outcome is at the tail end of the process. Your bank equally wants a fixed price because they want to know what it is that they're approving their finances for, because they won't want to go into it. On the converse side, the builder is not wanting to do a fixed price because builders are going broke with the fact that they're getting trapped in these fixed price contracts, and so you're going to have a massive disconnect where you have the potential for butting heads. Okay, now instead, the compromise is to go to a fixed price contract, but have certain elements that might be what is called provisional sum, where the named element might have a particular dollar per square meter rate, or particular dollar rate for that particular element. And what you're going to say is, look, not everything is variable. Okay, there's only certain elements. So, for example, it's just the cost of timber at the moment that you think is volatile. So just put the cost of timber in that provisional sum as an example, so that the majority of the contract is fixed and there's only one element that becomes variable. Now, in most instances, the builders, whilst they want to have everything to be a cost plus type project, they will actually understand that if you have that conversation with them and you actually build a rapport with them, that if they just list the one or two things that are genuinely, truly volatile, then chances are they'll be able to mitigate their risk, still give you the outcome that you're looking for your finances, satisfy the fact that you need to be able to mitigate your risk from a project profitability perspective and the like. Okay, so hoping that helps. Okay, so we're going to make this. I think it's a comment, might be a question. No, it's just a comment. It's from Tony saying that he is happy to talk to Chasen afterwards. So Tony is a builder, so he's happy to talk to Chasen afterwards. Folks, that brings up the hour. So that's been a great chat. Thank you very much for all of your questions. Hopefully you got plenty out of that for the open mic night, and that you got plenty out of the process. We're going to do this on a semi-regular basis and try and answer all your questions. So watch out when we promote it. Submit your questions in advance, and that means that I'll be able to help you on your property development journey. Until then, folks, looking forward to seeing you at the next meetup. So go to our website, developernetwork.com/events, and that's going to, I guess, then take you to all of the different events we run around the country. So Brisbane, Sydney, and Melbourne, 3 times a month we're running these events. And no matter where you're located, you're going to be able to dial into those via live stream. So whether you're there physically or you dial in via live stream, outstanding content, folks. So I'm going to say till then, bye for now, and I will see you on our next Sunday.